The changes could drive up the cost to buy a home or refinance one, as the Crown Corporation that insures mortgages for banks is now scaling back on the amount it guarantees.
The CMHC is effectively putting more risk on the shoulders of the banks and lenders. And what we're going to see happen is those risks will be passed on to consumers in the form of higher mortgage interest rates.
Canada's Mortgage and Housing Corporation will now limit its pool of taxpayers' money to guarantee mortgages against default. That's because the amount it made available for the entire year is almost maxed out. Its note to lenders on August 1st says the changes are a result of this unexpected increase of more Canadians buying property. Bottom line, say experts, home loans may soon become more expensive and even tougher to get, especially first-time buyers.
For people getting into the market, they could see tougher lending criteria to even qualify for a mortgage.
The move is Ottawa's latest attempt to further cool the housing market while shielding taxpayers in the event of a crash.
And they're trying to slow the market because they don't want an overheated market, because that can potentially lead to catastrophic effects like we saw south of the border.
Finance Minister Jim Flaherty has intervened several times, even criticized banks for keeping rates low. But this latest move, say realtors, could spark a last-minute frenzy.
There's been a ton of people just sitting on their interest rate holds right now, and they haven't been sort of jumping into the market until now because of the interest rate increase scare.
Even though very few Canadians default on their mortgage, CMHC's new plan designed to offload some of that risk onto lenders instead of Ottawa may come at a price to many consumers. And that plan is effective immediately. Graham.
Richard Madden in Ottawa. Thanks, Richard.